Ed, one of the questions I had while listening through your presentation was about, you talked about technical value versus market value. In your experience, how closely correlated are these numbers? Are they actually close to each other, or do they actually differ?
Well, at times they can match quite closely, but obviously the market value is moving all the time. Even the technical value can move because our underlying oil price assumption obviously is rapidly changing. Companies try not to move their long-term forecast every other day, because essentially, as an upstream oil gas company, we're not worried about the day-to-day volatility of the oil price. We're looking at the long-term price over the life of a project, 10, 20, 30 years. So we don't make development decisions in reverse in the next stages because the oil price changed by $5.
I did notice one thing about the valuation. In some of the charts, pre-sanction, the amount of reserves that are expected was the major driver, and the valuation is the most sensitive to that. While post-project sanction, in fact, the price of oil is what the valuation is most sensitive to. And I see you're about to say something, but my question was, was there any discussion about discount rates? How important are discount rates actually to the valuation of oil and gas reserves and resources?
Well, obviously, discount rate is fundamental. It should reflect obviously the cost of capital and the risk profile of the company. As a general rule, when we tend to use 10% as a norm, I think if you analyse the range of discount rates, it probably goes from 6 or 7% in the majors through to 14, 15% in some of the smaller E&P players. If you're a one-shot company with acreage, say, only in a very risky country, then your cost of capital by default is going to be the high end. Obviously, it makes a big difference. The NPVs between 10% and 15% are dramatically different. Again, that's one of the features of say, reporting in the US or Canada, where they effectively force you to report it at a standard discount rate just to take that variability out. Otherwise, you can't compare project to project. But at the end of the day, someone has to do the true valuation of the company, and that would be at its appropriate cost of capital.
One thing, another observation was you talked a lot about the chance of discovery. This is how prospective resources move up to contingent resources. And generally you use the figure of 10% as the chance of discovery.
No, 10% was just the example I gave. It varies. I would say the success rates are probably as low as 25% in a mature basin, but we routinely have chances of success of 6, 7, 8%, much less than 10%.
Okay. What are some of the things that oil and gas companies do to help increase their chances of discovery? Is there anything that they actually can do to actually get better odds?
Well, the only thing they can do is effectively more study. So in the early days, a lot of that risk is due to not lack of data. So you can go out. That's why companies spend a lot of time, can spend many years getting to the point of drilling. They're shooting seismic. One of the biggest things you can do is acquire seismic data. So definition of the traps helps. Collecting well data, getting scout information from other people's wells, because the most important thing and one of the most important data points is obviously well data. So if you can get hold of other wells, even dry holes, you can learn a lot from the dry hole. At least it tells you what doesn't work and why it doesn't work. So in some basins, say in the North Sea, of course, wells are published quite routinely, so you can everyone can acquire the entire well database. Obviously, it's kept secret for a certain amount of time to keep companies' competitive advantage, but after a while, it's all disclosed. So, the first thing you should do is actually analyze the entire database available to you.
Okay, so basically what's important is more data, more drilling, and more concessions. So in other words, the law of large numbers, which you mentioned in the last session, is very important. And essentially, you need a portfolio of different projects and concessions to have your best chance of finding anything at all. So Jeff, similarly, we talked about building portfolios and how investors need to build out a well-rounded portfolio. Anything you can talk about in terms of how the types of oil and gas companies we have here and how a portfolio can benefit from that?
Sure. We have, obviously we have a range of sectors and a total multitude of businesses that are represented by the companies listed on the Singapore Exchange, and this very much resonates as well in the oil and gas sector. We have, I guess our benchmark is the FTSE ST Oil and Gas Index, which is only made up of 12 companies, 12 oil and gas companies, and it basically has performed about 10%, it's made a gain of 10 to 11% over the last 12 months. But the universe of stocks that make up the oil and gas sector is much more. We have 5 companies, 4 listed on the main board, 1 listed on Catalyst, that make up the oil and gas exploration and production companies. These companies, the largest of which is RH Petrogas, the second biggest is Intera Resources, then there's Ramba Energy and Marak Energy, and then Lloyds is on the Catalyst board. Those 5 companies, I guess, are at the exploration point, and 3 of the 4 main board stocks were actually producing oil as of their 2011 annual report. Now, these are at the crux of the oil and gas sector. Then you have another 17 companies that are providing oil field services to oil exploration and production companies. These 17 companies are providing evaluation, production, drilling services and so forth. And then the universe also extends to the shipbuilders, the rig builders, and the various engineers of the business. So in total, there's probably around 35 to 40 stocks listed on Singapore Exchange that are heavily involved in the oil and gas business and in various diverse subsectors of the oil and gas business.
And with that, does anybody else have any questions? There's a lady over here. Please go ahead.
Hi. I was just wondering, would the valuation approaches differ a lot from region to region? For example, Southeast Asia versus Europe versus North America. And how about the say total size of fields? Does that also affect the valuation approaches?
Well, for a start, the valuation methodology is applicable anywhere, as long as it's oil and gas. So we wouldn't use a different methodology, whether it was the North Sea, whether it was Australia, whether it was the Far East or the Americas. What does change is field sizes, and that's a reflection of geology. So, the field sizes generally yet to be found fields, say in the Far East, is generally accepted to be smaller because it's quite mature. So what generally happens in a basin, tend to find the biggest fields first, tends to be the usual way it goes because they're the most obvious. And with time, the more mature it gets, then people start finding the smaller and smaller fields. And obviously the smaller fields become more economic on the back of the big fields because you've got infrastructure which to tie them to, so you wouldn't go looking for them in the first place anyway. So field size is very, very important. And I'm not an expert in Far Eastern geology, but a lot of the basins, because they're more mature, then the field sizes tend to be smaller. But then, because there's lots of infrastructure, they still have a lot of value because they're tying into infrastructure. In a new basin, West Africa, deep water, then people are finding much bigger fields because they're early in the exploration phase.
Okay, and the lady next over here, and then the gentleman next on the aisle.
Okay, thank you. I have 2 questions. I met with a company today who told me that they have a certain resource value that has had the JORC report, and they require certain funds to convert into reserves. And they gave me some numbers to justify the viability of the investments. And it's, from what I understand from your slides, I might be slow in that. But when something converts, when the valuation converts from a resource to reserves, it's not necessary it will be increased, right? Is it correct? If I go for your formula.
The volume doesn't necessarily increase, no.
Not volume. What about the valuation, the way...
No, there's no change in value. Well, the only change in value is if you've got risk attached to it. If you take the risk away, then the value goes up. Because there's obviously you've removed the chance of either failure or non-commercial outcomes.
Okay,
so the risk value will increase, but the underlying success value, if the volume hasn't changed, then the underlying success value has not changed.
Okay, so that is the only variable, the risk element to it?
In that particular case, the change will be the risk. Now, life's never constant, so every time we collect new data, we tend to go back and reevaluate things. So you may well refine the distributions or refine the volume range once you've had more data. And sometimes that moves the whole, the distribution just doesn't tighten entirely. It'll get narrower, but it doesn't just automatically tighten on the central number. What might happen is it tightens up, but it tends to maybe shift down or shift up. So sometimes you can post appraisal ready for the development. You find it, yes, I am more certain on the volume, but the volume is much smaller than I thought when I started, because I've just eliminated the chance of it being a big field. It's much, much smaller. And I say, in history tells me that it moves downwards more than it moves upwards.
The second question I have is, there is a field that has been mined before, and the owner abandoned it. And this the new owner that comes in is so certain that it will make money from it. Is it possible?
Well, abandoned fields, are you talking about?
It's an oil and gas. It's a field that has been mined and abandoned, and another set of owners comes in and thinks that they can work.
Yeah, I've heard of these. Actually, this was one of the questions I had for you. So let me see if I have your question correct. The field was explored and developed, and there was oil extracted at some point in the past, but for some reason the field was abandoned. And most of the time I've seen is that it was abandoned in the 90s when oil was $20 a barrel. But today, when the owners come back or different players come back and look at those oil fields, they find that at the higher oil prices and with new technology, that they believe the abandoned fields are feasible. Is that what your question is, essentially?
It's not even that far back. It's like back to back. One owner went in and started mining and found it. You can't make it viable, but another set of people can do it. Is it possible?
Well, there are a lot of cases of fields which are abandoned. Another company comes along and it's effectively technology as opposed to price that makes a difference. Remember, of the oil in place, the oil that's under the ground, so the recovery factor, the amount of the percentage you recover could be as low as 30%, maybe 40, 50% at the upper end. So more than half the oil has been left behind in the ground. Now, engineers are always working to try and increase recovery. So if you can get, especially at today's prices, if you can get a few percent more recovery out of a field by applying some different technology, which you might be more expert in than the previous player, then that's fine. I mean, the other thing that happens a lot of times is the bigger companies say, well, it's just not worth it's too much effort to extract now. My overheads almost are too great. I can't make any money on this because I'm just not geared up for this small type of development. So they can let it go. We're even seeing this offshore in the North Sea now, of small companies with only maybe half a dozen employees coming back and saying, well, we can get all the technical help we want through contractors, but we've got a good idea of how we can increase production. Our costs are so low that we can make money even on a small volume of incremental oil. So we are seeing a lot of brownfield redevelopments, and sometimes fields which have been reactivated, which have been abandoned 10 years ago. So it is quite possible. So I wouldn't rule it out. In fact, there's a lot of money being made by small companies on taking over mature fields and effectively refreshing them.
Thank you.
Okay. The gentleman over here, and then followed by the gentleman in the front, please.
Hi. This is regard to the valuation you mentioned. I mean, there are two ways. One is that you can do NPV, or you can do it normal cash flow without considering any factor of inflation or other factors to be inbuilt. Now, you also mentioned about a listing of a company which does not have a barrel of oil. I don't know whether the status was it was not proven yet or it was still in the discovery stage. Now, you said the value is 2 billion. Am I right? Now, how, from two angles, one is from your angle as how do they value that, and second is from the stock exchange point of view, how they allow this to be listed, where the risks are so much. Yeah, that's one of my question. Second is that, like in the coal mining industry, we hear a lot of job companies who certify the reserves, and based on which the valuation is done based on per metric ton. Now, is that also happens in oil and gas, where there are approved companies when they certify the the reserves, and it is sold on the basis of, say, per barrel? Thank you.
Well, on the first question, in terms of a company that doesn't have any reserves, we can still, what we effectively do is we have to assess what the volume of oil in the undrilled structure is. So how much could that field contain if it was discovered? So we do assessments on the area and the volume and the likely nature of the reservoir that might contain the oil. We can also assess the risk. So we can undertake a DCF analysis of prospect if it were to discover hydrocarbons. And then we can apply what's the chance of that occurring, and then we can do our DCF analysis. So the case I've talked about, we did do that. We did an evaluation of the fields. If we assumed they were discovered, this is how much money they would generate. And then we applied what's the chance of finding them. So obviously there's a lot more uncertainty, but we just actually had bigger error bars on our assessment. So that wasn't any different.
Yeah.
Second question was on using unit values, in effect. I mean, unit values are popular to be used, generally speaking, for quickness. So in an area that's well understood, then you may be able to quote, value of a barrel in incremental barrel in the North Sea is always equal to the same value, because the fiscal terms are pretty understood, and they're pretty much linear with them between volume and value. It doesn't work always, but it is a quick, rough and ready metric that a lot of analysts use all the time. So quite often people read reports, will extract the NPV per barrel and then use that to apply to reserve estimates from another company that hasn't quoted the value. I mean, as an expert, we would always go to the point of calculating the underlying net present value the correct way, because we've got the data and the time to do it. As an outsider, if you don't have that time and that data, then yes, it is used a lot by analysts.
I want to address what you asked about the listing. I think the case study that Ed had mentioned, it's a company that's listed, I believe, in London, right? And your question was, how can this company, even without reserves, how can they even seek a listing? But I think once a company reaches the reserve stage, of course, that is at the level that you're most comfortable, because the oil is essentially already proved economic. But there's still also, for those companies that have contingent resources, which, as Ed has mentioned today, and I think in previous sessions, this is a situation where the oil is already discovered, but it just needs additional development before it becomes economic. So in cases like this, companies can also seek listings, because now it's a matter of development risk. Now, the third case of companies with only prospective resources, which, if you recall the diagram, to move from prospective resources to contingent resources, you need to overcome a chance of discovery. And I do agree that purely on the basis of a chance of discovery, it's very risky for public investors. But on the basis of developing a project, I think it's something which is within some level of reason.
I mean, one thing that company had in its favor was it didn't come to market with just one or two prospects to drill, whereby effectively the chance of winning is quite small, because there's you're only placing a bet once or twice. What they had was constructed a portfolio of prospects to drill over the next 5 years, probably about 30 or 40 prospects, and it was the consolidation of that which sort of led us to believe that, and these were all, and because they spread it around different countries, effectively we were dealing with independent trials. So they had Tanzania, they had Gabon, they had Equatorial Guinea, they had Somalia, they had a big portfolio. And if you looked at the probabilistic outcome of drilling that, then there was a very high chance of finding something somewhere in that portfolio.
Okay, so to summarize, they had a large portfolio and they had already done some amount of work, right? Yeah.
They've done a lot of technical work, so they defined those volumes and those risks. And subsequently, they have found, the analysis would have said that out of the 6 or 7 areas they were exploring, one might expect to find oil and gas, at least 1 or 2 of them. And they've now found big gas discoveries in Equatorial Guinea and big gas discoveries in Tanzania. The rest are not fully drilled out, but I mean, they've essentially found what they thought they would find, but through the statistics.
Thanks.
But
Thanks.
if I'm not wrong, sorry, just to finish that. If I'm not wrong, SGX has a requirement that there must be authenticated reserve proven before they can get listed.
To this on SGX, an oil and gas company must have an adequate amount of contingent resources. So the companies have already done some amount of work, and they need for the capital for development. Of course, there will be some companies that will already have reserves and resources, or some portfolio of reserves and resources.
This particular company is quite a rare example. Most companies have, like the Heritage Oil case, they did have some discoveries, and the rest was exploration. This was a company that had all exploration, which must have been quite unusual. Just shows you the amount of money in the market at the moment. They were oversubscribed in London on the main board.
Thank you.
The gentleman in the front rows.
Just follow on for that lady's question about the brownfields. When you do an evaluation on that, if you've got a field where through technology like enhanced oil recovery it goes from 30 to say 60% recovery, that 30% extra 30%, is that still in contingent resources or in reserves, or how is that actually done when the information goes through? So you've got an old existing technology and then the new technology. How does it follow through your PRMS classification?
Well, I think it really is whether the technology is proved to be feasible. So if it's an untried technology, probably would be contingent resources. I'm looking across at one of our engineers. See if he's nodding or not. We have, I think, an example from the North Sea again. We had a company that produced very heavy oil. So the issue of recovery was, can they get it out? And they were using new technology, effectively going to try some horizontal drilling into this heavy oil. So the only way we would give them reserves is if they didn't have to go and discover it because it was already there. What we insisted they did was they had to do a long-term production test in a horizontal section to demonstrate they could move the oil. If they can move the oil in a long-term test, then we'll reclassify it as reserves. So while it was being in that long-term test phase, it was in contingent resource.
But that's based on a test in that particular basin or area?
Correct, yes.
Any further questions? The gentleman in the front corner. Maybe you can just get the mic from...
Just a quick question. Just now you're talking about companies with a portfolio of oil and gas projects. The normal cost evaluation, would you use real options methodologies to look at the value of a certain pattern of exploring, of approaching these concessions? Is it something you all normally do?
The short answer was we probably should. The problem is that most of us are not capable of modelling real options, so it's not used very often in the oil and gas sector. But you're right. We could apply real option theory to a lot of other work we do.
Is real option accepted under PRMS?
It's not mentioned at all.
How about development code? And would that be one of the...
No, it's not mentioned. I think it's beyond the understanding of most reservoir engineers and geoscientists, I think. It's presented a lot at academic conferences, but it's yet to find effectively use in favour within the oil and gas sector.
A gentleman on the far right.
Yeah, I just have a question on the Tullow Heritage example that you've highlighted here. Really interesting to read that Tullow essentially put a valuation of 2.7 billion on those two blocks. Is that correct? It's 1.35 for 50%.
If that's, yes, effectively for the 100%, yes.
For the 100%.
But they actually own the other 50% themselves, so they're actually taking 100%, so they're buying the remaining 50%.
I see. And your valuation was 1.6. Was that for the 100% or was that for the 50%?
That was for the 50%.
So, okay, so essentially...
So they paid 1.45 for what we thought was 1.6 in value.
Is that like a pretty common discount against valuation, or is that...
Well, I would say usually that's a pretty uncommon discount, because it's actually quite a high price to pay. I mean, if you look at transactions, I mean, people, generally speaking, don't get away with underpaying for reserves anymore. So usually people are paying almost full value for reserves.
Yeah, but these are resources.
For resources, what people are paying would be, a fraction of that. I mean, effectively, most people are justifying the premium on the reserves by paying a little bit for the upside potential and the exploration acreage. Now, when you've got companies like that, where people are paying $1 billion practically for all the exploration, that's fairly unusual, but it was a pretty unique and hot area. Because Tullow and Heritage combined, it drilled about 10 successful wells in a row between them. So it was a real hot streak.
But the fact that they own 50% helps.
It did help because they knew, they knew. I mean, there's a bit more history to that. Effectively, it was Heritage had an offer from another buyer, paid cash, and then Tullow effectively used its preemption rights under the contract to match the offer. So it wasn't that Tullow wanted to buy it, but they decided they preempted, and they've subsequently unsold quite a large proportion of it to E&I, the Italian.
Right, so it's first rights of refusal against a third-party price.
Yeah.
Okay. Second question, or simpler question. Do you build in the quality of management into your valuation reports?
It's not built in quantitatively, but we have to address it in a qualitative sense in our mineral expert report or competent persons report. It's quite difficult to build in quantitatively. It's like, do we build in political risk? Not really. We address it, but it's hard to quantify and then put a number on it and then to effectively use that. So, no, we don't, is the short answer.
Right, especially since they're paying your fees.
They're paying fees, but we're still in classes independent because our fees are not dependent on the outcome. I mean, that's the secret. We're not like a financial advisor who may be paid a success fee. We're paid a flat fee for the technical work that we do, regardless of whether the deal goes through or not. So under the regulations, that way we're deemed to be independent. We can give an honest opinion. It makes no difference to us whether it occurs or not occurs. So we don't have to inflate it just to ensure we get a success fee, I think is the short answer.
Thanks, Ed.